Hey everyone, me Kevin here. The market feels like it is in turmoil. You've got all the indices down. The Dow is down over 445 points. The S&P is down another percent, another day in a row. To me, this is a potential lead up to this S&P correction that who knows we might see. I'm not sure, but there's one thing I know for sure, and that is we do have some insights on why this madness continues to happen. In this video, we'll also be going through some of my top picks based on future earnings multiples, and we'll see which ones feel like a bargain compared to which ones feel expensive. So we'll touch on that as well. So let's get right into it. So obviously right now, there's no doubt the target of the market sell-off is tech. And that's very clear because short interest in the market is up 2 percentage points again. We are up to 26% short in the market right now. This is far from the peak that we had of 35% in 2020 in March. Now, we don't really expect to go back to a 35% short interest level like what we saw in March of 2020. We certainly had way more of a catalyst for a market crash then than we do now. Now, we're just being weenie babies over a potential spike in inflation, which we knew was coming. But anyway, we are definitely seeing short interest going up, and tech is without a doubt the easiest target here. But the craziest thing is you think that, oh, okay, well, they shorted and now they're making money. They're done, right? No. The hedge funds continue to short. We're continuing to see short interest data go up. And because shorting is not at extreme levels, there is less of a worry by hedge funds that they're going to get squeezed like they did with GameStop. 25% as a market short level is nothing compared to the 130, 140% that GameStop was short. So don't get too excited that if hedgies are shorting, we might be able to squeeze them. Instead, according to Miller Tabak and Co., in an interview this morning, all sectors continue to fall as hedge funds continue to add to their short positions. It's a bet that's been working very well. So rather than taking new money and buying the dip, they continue to buy their shorts. And that continues to remove buying pressure and continues to add to selling pressure. Now, we also had Swiss Global Equities mention this morning that they believe this bull market, that the overall bull market that we're in, looking at the scope of over the last year, not so much the last 3 months, but the overall bull market, they believe will really only come to an end when we go into a recession. And right now, we're not heading into a recession, they say. They say instead, this is really between now and February, it's really just been a bump in the road. It's creating buying opportunities, but it's not the start of a recession. So we'll be back on our bull market trajectory, they believe. Now, we don't know if they'll be right or not, but hey, the economy is being held down by the fact that less people are getting jobs. We saw Friday's unemployment data come in way worse than expected. We only added about 288,000 jobs compared to 1 million jobs expected. We did get a job openings report this morning that there were 8.12 million job openings versus the expectation of 753 million jobs expected, or job openings expected, which is a difference of about 600,000. Which if those 600,000 jobs had been filled from those openings, that difference there in expectations, and we saw that go to the jobs added report from last Friday, an employment report which shows that, we would have been closer to expectations on both reports. So it's really, really clear. We have the job openings, people just aren't going back to work. Now, earlier in the live stream this morning, we talked about how, my goodness, McDonald's in Florida is having to pay people to get interviewed, $50 just to get an interview, whether you take the job or not, just to have people to talk to try to give them a job. People don't necessarily want to go back to work, and it, in some cases, does make sense given the fact that we are still seeing a basically minimum wage equivalent unemployment boost through September. And as a result, Bloomberg reiterated that, quite frankly, because of the things that are happening in the market, not only with unemployment, but these inflation fears and the increasing of shorting, Bloomberg suggested and reiterated that no one was going to be surprised if this correction continues to go deeper and longer. The Swiss firm we referenced also believes that inflation at some point will hit a peak, quote, soon. Now, they believe that the markets, overall tech sectors and the other parts of the market, will start to react positively when that peak gets hit and we start seeing a decline in inflation figures. Now, what I really think they're saying here is when we hit an inflection point in inflation, we could see a quick rebound in equity prices, specifically the tech sector, which has just been getting destroyed, as hedge funds have to start preparing for that inflection point and they start unloading their shorts. Now, that's an interesting theory. It's obviously one that I certainly hope is correct. But here's just a quick and brief visual way to think about that. If hedgies right now are seeing inflation expectations do this, actually, it's not really a rate that's been going up. It's kind of been more like that. If inflation expectations have sort of been moving like this, and hedge funds since February have also been shorting at a sort of a similar path, then at some point we're going to hit this peak inflation level. Let's say that's, I don't know, I'm just gonna make this up, okay? Let's say peak inflation. Peak inflation ends up being somewhere around July, as just an example. And we end up seeing peak inflation and peak shorting because the shorts are trying to anticipate what's happening in the market. We end up seeing peak inflation here. And as we start getting data that suggests, okay, we had our big inflation. Now we're going to start seeing that inflation go down. I really think that could, probably going to be July, because in July we'll get the June data. Yeah, I'm going to stick with July. Let's say we see that peak in July, and we start seeing inflation and inflationary expectations going down. Generally, the short sellers, the blue line we're drawing here, are going to start unwinding their shorts because they don't want to be caught shorting a bunch as inflation expectations are declining. Obviously, worst case scenario is this peak of inflation continues to go in this green line here. That's the worst case scenario, right? So we're all tentatively waiting for that inflection point. And the hedge funds are watching that very closely as well. If this inflection point turns down, it would not be surprising at all to see the current inflation levels of, not inflation levels, the current short interest levels of around 25, 26% to start going down. And what happens when you start closing these shorts is you start buying back your shares, and then you use new money to buy new shares, and you potentially see that U-shaped recovery in stocks, which would kind of look like, okay, we're going to the moon, then we fall February, March, stay kind of at the bottom, April, May, and start trying to come out maybe June, July, and hopefully we see a recovery. This could all be for nothing. I mean, this is totally just speculation. But the point that this would likely become very true is when we get to this one specific point here. When this point happens, when we get an inflection point in inflation data going down, that is when markets and hedge funds as well, the ones doing all the shorting right now in the tech sector, when they expect to start unwinding. We even had Gene Boivin at BlackRock Investment say that markets right now seem to be extrapolating good data that and basically implying that the market is overheating. And so what they're doing is they're going, oh my gosh, Q1 data, Q1 earnings, we're so good at tech companies. Data, GDP, everything for the economy's health and growth is exploding. Housing prices up 16% in the first quarter. Everything's exploding in the first quarter. That hedge funds and even mutual funds are looking at that data and going, oh my gosh, if we continue on that trajectory all year, we're going to the moon, but we're going to have mega inflation because we're overheating and the Fed's going to have no choice but to dampen. This particular person, Gene over at BlackRock, says, hey, markets are a little bit over extrapolating good data. And they say that, remember, the Fed has a really high bar to raise rates. And if you're extrapolating data, that's not going to be at that peak level all year. We're going to see a softening in that overheating data. And the Fed's not going to react as quickly as you think. You might be acting a little prematurely and in shorting too much. And once the market realizes that, we might see that rotation away again. Who knows? That's just what Gene over at BlackRock thinks, which kind of echoes what the Swiss firm believes. And I'm purposefully referencing other companies and statistics, or should I say, interviews here, because I don't want you to only hear from me, and I don't want to only hear from me either. I don't want to sit in an echo chamber and just say the same crap. I'm looking for what other people are thinking. For example, on CNBC this morning during our live stream, we heard firms saying, hey, what we're doing is we're looking at what we think is a good deal, which I'm going to talk about in just a moment, and we're just adding to those. Sure, may things fall even more? Yeah, but once we get that U-turn, it could come much quicker than we expect. We'll see. Loretta Mester, she is a Fed Bank president, said that equity prices are high right now, and she does see inflation staying or ending the year at above 2%, but She thinks that we're going to get a rotation down in inflation, so potentially that inflection point, by next year as supply constraints ease. Now, that's interesting because that makes you wonder, well, wait a minute. Does that mean Loretta Mester thinks the inflection point is in July, or does she think it's more like a January through March thing of next year? My guess is it's actually kind of potentially both. If supply chain constraints get better in January through March of next year, then we'll probably start seeing the inflection point downwards sometime between July, September, October of this year, and then really get to normalized levels sometime next year, which would sort of align with what Loretta Mester suggests. But it certainly doesn't help when the Fed's going, yup, stocks are high. All right, whatever. I mean, they were saying that in the summer of last year, too. They're like, oh, yeah, equity prices got up real fast. But anyway, these are some, I want to go through some names just briefly here. Some of the names that I think are some picks that you could look at 2024 earnings and go, oh, these have actually dropped to levels where they're kind of nice to add to. And I want to mention these. I do quickly want to mention that coupon code that was extended briefly is still available. Get that 39% off coupon code. You can check out those programs down below. You get my private live streams. You get and those won't last forever, but the private live streams, I have no plans of ending those. The private live streams, I love doing those with all of you, but you do get lifetime access to all the existing lectures and new lectures that I add. So they're kind of like living, breathing courses. They continue to expand. Check those out down below on real estate stocks, the psychology of money, YouTube videos, real estate agent sales, you name it. But here are some of these that I'm looking at. So I've got three sort of baskets of stocks. I've got what I think are the lowest future multiple stocks, the medium multiple stocks, and the high multiple stocks. That means which companies am I paying the highest dollar volume for right today for future earnings, 2024 earnings, and which am I paying the least for? And we go through this in detail in our private live streams, but just to give you a generic overview of some of the things that we've been talking about, we've been finding that the lowest or sort of the best deals right now with the sell-offs that we've been seeing for forward earnings have been companies like Etsy, Pinterest, Enphase, and Shift Technologies, with the most expensive being companies like Redfin, Palantir, Tesla, and Square, and the sort of the middle group being something like we've got here Coinbase and Peloton being in the middle. Let's see here. Yeah, so these are some that I find pretty attractive right now. A little bit of all of these, but I'm trying to keep that balance between all of them. So anyway, this gives you a little bit of an idea of some of the things that I'm looking at, and I think this was really interesting insight about what's going on overall in the market. So thank you so much for watching, folks. Really appreciate it, and we will see you in the next one. Bye.